Hey traders, this is Ron. Happy Tuesday. Hope you guys had a fantastic day. As always, everything in this presentation is for educational purposes only. All right, we're going to kick off here with SPY, the S&P 500 ETF. We were down on the day under 1%, bounced way off the lows. We're down about 20 plus points on the S&P or $2.39 on SPY. Now, upper right is where we are right now. Lower left was last December. This is when they told us, I'm sorry, there's been so many times they told us the world was going to end. I can't keep track anymore. Back here in October was a high, right? Came down into November. We bounced. We went back down mid-November. We bounced. And then December, what is that saying? Katie bar the door and down we go. And it was the worst December on record. It was crazy. It was horrible. And that's when the mother of all tops was in, yada, yada, yada. And then we saw what happened. Vicious V rally. I would argue epic proportions. We then come down, we bounce. World was going to end in April and May, right? Then it was going to end in July. Then it was going to, yeah, and here we are. So this is what I do. Put your fingers in your ear, ignore all the talking media, fear sells, and whether you like the president, hate the president, doesn't matter. The one thing we all have in common, I think we like money. And I would argue, let's just go with what we see and not what all the talking yo-yos on TV and everybody everywhere else want to have to say. There's lots of reasons why this market should or could go down, yet it keeps going higher. Well, guess what? They just might be wrong. And the one day they're going to be right, they're going to point to that, try to sell all their crap and say, look, told you it was going to crash. Meanwhile, the other 9 times they were all wrong, running around with the sky is falling theory. Now, if I zoom in here, this is the trade station on a daily chart. We finished basically at the highs of the day. This to me shows a lot of strength. And in fact, if I were to transition to a different stock, here's a stock called CARA. I don't know what they do, CARA Therapeutics. This stock was down $8.88 today. Why am I talking about this so early in the presentation? Because this was the biggest loser according to when I was in Thinkorswim earlier. The biggest loser on the day. So you would think with the markets getting, maybe whacked around a little bit, beaten up a little bit, that was the biggest loser, a weird stock, and it was only $8 down when there's stocks that are hundreds of dollars, $1,000 plus. Yeah, that was it. So today was not one of those, oh my God, moments where the sky's falling, everyone's selling everything, they're running to raise liquidity and capital. And no, we've had 3 red days in a row. So where does that stand as we walk into Wednesday? I love using moving averages. Now we can use Ichimoku. Maybe we'll do that in a different webinar. But the 20-day EMA here in red, that line right there, we got below it. So when that happens, what that tells me is caution is needed, just in the short term, because 20 days is a month's worth of data. That's it, just some caution. We get below the 50-day, that's when we're going to have a different conversation in this video and say, uh-oh, looks like things are getting a little ugly. Maybe it's time to, be way more cautious. But that is not now. Right now, we're below 20-day, caution is warranted, but that's it. If we take a look at the diamonds, type in DIA, which is the Dow ETF, we were only down 200 plus points. If you listen to the media, the breaking news and oh my God, the trade wars, every time the market goes down, they love to use the trade wars if it's always the reason. The big money does not listen to this nonsense. It makes for a great headline, makes for good talk if you hate or like whatever it is that's going on in the world, but price rules. So every time they keep telling you about the trade wars, they're a bunch of jokers because this is where we were when they said the world was ending, and this is where we are now. Did the market go down on trade wars? Nobody knows why the market went down. There was simply more selling than buying. And when they jerked the market down last December, the volume overall in the marketplace, the activity of the bigger players isn't always there. Now, are we going to see a repeat? We just might. Maybe this December is going to be really awful too. So how do I approach it in trading? Zoom in. The first caution here is the 20-day in red. If I'm trading individual stocks, which we're going to look at a couple, we'll do Apple, Google, Disney, we'll do Shopify, CROX, we'll look at some others. We get below that red line, short-term trade, bullish trades are stopped out. So if I was trading the diamond short-term here, I'd be stopped out. Now, sure, there was a gap, but it's the end of the day, come home from work. We're below 20-day, very easy decision. I exit the trade. Some folks are going to say, oh, look at that volume. Oh my gosh, the volume spiked. 2 different things here. First of all, if I zoom out and we look at the volume, look how little that bar is compared to the bloodshed that was going on, if you will, over here in December. It was just, they were throwing everything out. Yep, that's not now. Second, look where we finished. Highs of the day, not lows of the day. So I take it in context. Now, with that said, let's just say tomorrow, another bad day in the market, and it comes all the way down, and we get another, I'll call it a hammer type candle reversal off the lows, and we're below the 50-day. Hey, at that point, it is what it is to me. Now we've lost two significant moving averages for trend trading on a daily basis. I can no longer be bullish on a 20-day period or a 50-day period. In fact, if that were to happen tomorrow or Thursday, whatever it might be, we're going to start looking at weekly charts together. So I'm just trying to give some context. I didn't do a video last night. I really wasn't worried about the move at all. Today we get the gap down, but we come off the lows. So all this big tall bar here, sure, it's taller. It's the tallest bar since basically October, but we finished off the lows. So there was either short covering or just flat out buying that was in there. Let's take a look at the Qs. What do you know? Same thing, finished at the highs of the day. Yes, we're still down and we lost a whopping 1.74, but when you look at the percentage losses, today wasn't bad at all. Even at the lows of the day, it wasn't that bad. And usually what happens once we get into midday, if there is a big sell-off, it's one or the other. We go back to the highs of the session, or we go to new lows. This time it took it to the highs. Let's see what tomorrow brings. Today's volume was higher than yesterday, but we're off the lows. Again, watch the 50-day, and that's when things will change. So I'm giving you guys my roadmap, and I hope you find this helpful. I just try to keep things in context, but you just take it one day at a time. If the 20-day was my trailing stop, I would have gotten stopped out of a lot of stuff today, at least if we're looking at the major moving averages. Now here's the IWM, the Russell. The Russell was actually up a couple pennies. I'm sorry, that was IWM, sorry. I was going to say, wait a minute. It was up off the lows. I'm like, I didn't think we got green. But my point is, it was only down 0.29%. That's practically a win. It's less than half of what the others lost. And we're still holding actually some of these lows from that 158 area. The IWM held the 20-day EMA. It's been the weakest for quite some time. If I zoom out, remember, its all-time highs occurred back there in August, back in 2018. We started to break out. That could add the next fuel to the fire for the bulls. So far, even on the pullback, it's holding up pretty good. All it did was back test today. If we take a look at XLF, just take a peek at the banks. I'd like to see how they performed today. They were down pretty much with the others, 1.54%, a little worse, you could even say. That's a hammer type candle, but please, if you're learning candlesticks, that's not a hammer candle. It might look like one, but it is not. We would want to see that way down here or something, not in the middle of a down or the beginning of a downtrend. It did hold this 29.50 area, which is interesting, but right now the target, once you break the 20-day, it's pretty much down to the 50-day, which is 28.75. That's another, what, 75 cents lower, maybe like 2% lower. If we take a look at dollar sign VIX, .x here in TradeStation, the VIX was at 18 today practically, finished just under 16. As the markets rallied off their lows, the VIX came off its highs. This does constitute a breakout because you were below moving averages one day. Today was a second day. I was reading something on Zero Hedge about there was a put buyer that made like $30 million today because they bought their puts last week. It was like a 2-day trade. But here's the catch with that. That could have been a hedge against another position. Maybe they knew something. I have no idea. And the only person that knows is whoever did it, whoever did the trade. But the VIX is short-term bullish. This is bearish for the markets. It is matching that the S&P is pulling back. So if we go back to SPY, sorry, I'm typing a little too fast here. SPY, we're below the red line, and VIX is rising. So we don't need them both to be above 20-day, 50 days in that. It's VIX up, S&P down. They're moving in that sense, they're moving in tandem. So caution for the week, Wednesday, Thursday, Friday. I'll be back with you tomorrow. We'll do a video. We'll just see how things are performing. Now on to gold. Got some questions on gold and silver. Gold is just doing a long flagpole, and this is a flag. It's still in a downtrending channel. Gold came way off its highs today when the world was ending. Here's silver. It was up a little bit today, 1.58%. No change in the trend. Now, Apple, there are some cracks in the Apple cart. Just like the S&P, we're below the red line. So if I was trading Apple on any of these breakouts here, around 230, we talked about it. We talked about it after earnings. It's a nice trade. Now we're below the red line. Short-term movement for the bulls is over. They've lost their edge. They need to regain that red line. So if I was trading something, again, this is just for educational purposes, but if I'm out there with a 1, 2, 3 month option, we're below the red line, I got to bail. I can't hold that call anymore. If I'm holding stock, maybe I can consider covered calls now up near those highs, maybe for the front month. which in this case would still be December, maybe even think about January. Right now, the downside target, 50-day. And how Apple goes, so does the market, the broad market. And the Apple's just doing exactly what the S&P is doing right now, it seems. Here's Google, finished up on the day by 14 points, about 1.15% according to TradeStation. We're barely below the red line. So Google actually finished up on the day. How about the mouse house, Disney? This thing, we said grab the popcorn, right? Watch, wait for that earnings report, pop, and then we're off and running. Today it was down almost $2 whole, almost 1.21%. And also keep in mind that if the Dow's down, 500 points or something, it makes for a wonderful headline. But we're at such lofty levels, it's not the same 500 points that it was 2 years ago. Two different animals. Here, Disney down. Does this do anything to the uptrend? Nope. Was it bearish engulfing on Monday? Sure was. Let's zoom in. Bearish engulfing is when we gap higher and then close lower, and we encompass the bodies of the previous days. We had a 3-day bearish engulfing. This was a big old party, and now we have a down move. Is that confirmation? Well, there was a down move, yeah, but under ideal circumstances, what I would want to see is, okay, you got bearish engulfing. Where's the spike in volume? Oh, there wasn't any. That's the first problem with this. Second, you actually closed higher than where you opened. That's another problem for the bears. This is not a beautiful looking bearish engulfing pattern. It's quite weak. Overall, this is still bullish. I would continue to be technically bullish on Disney as long as it stays above the red line, which is a 20-day EMA. I think, total personal opinion, but this Disney Plus thing, it's huge. It's absolutely huge for Disney. They're talking about it trading at valuations it's never been at before, yada, yada, yada. Like, what does that even mean? The business model now is different than what it was 10 years ago. Once again, fingers in the ears and ignore all those people. We'll leave it at that. If it does get below the red line, then we target the 50-day. There are some Star Wars movies coming out, etc. That's going to add, but I can't tell you what that's going to do to the earnings and stuff like that. I don't dig that deep. I love the trend trade in Disney's in a seasonal window. This is where this long call produced as much as an over 100% return. So it did fantastically well. And the way I like to teach it is first long call off at 20%, second long call off at 100%, third one, let that puppy run. See how far we can ride that pony until it gets below the stop point, which is the 20-day EMA. And we're not there yet. So following along on paper, 20%, 100%, check, check, check. Now we're just waiting for the third one. Now we just want to get out of that by expiration. So again, that is a paper trade, not a real trade. I am not a licensed financial advisor. Cannot tell you what to do. How about Shopify? Shop was up. And what it did today, interestingly, it was up 18 points. Remember, the biggest loser of the day was CARA, was down $8. So it blew that out of the water. It just closed above this previous high from 10.15. That means the target on Shopify is back up there towards 400 plus. That's $50, but geez, that's what, 12, 15% maybe higher. The stop, I would consider probably the red line, but that's way down there at 323. Point is, big volume, bullish engulfing, closed the highs of the day, broke out above the previous high. Even in a weak market, this thing is looking good. And then here is CROX, CROX. This thing came down, hit the 50-day, and bounced, finished in the green. The 50-day would be my trailing stop here. Last time it got below it back in August, just for one little day, got right back above it. So this, I think, makes for a reasonable stop. 32.91 is where the 50-day is. Stock's at 34.22. What is that? $1.30 or so, in theory, stop loss. But keep in mind, though, this stock could go from 34 to 0 in a day, and so much of that stop loss, right? But in terms of theoretical stop loss, it looks interesting. There you have it. Long video, but I hope you found it helpful, just talking about the broad market. Again, buy yourself a good pair of earplugs, ignore all the media, and let's just go with what the big money is doing. And if we end up getting caught in one of these Decembers, and which is interesting is, I got this question over the weekend, how did you know when there was trouble in paradise? I'm just going to end with this. Look at the volume spike, and you broke the 50-day. When that S&P closed around 278, that was it. It was so easy to see. And then we go from 278 down to 260. We could not get above the 50-day. We come down, we got above it one day, and then right back below it, you could say you were stopped out again, and then you missed the carnage from 270 all the way down here. Nothing's perfect. You don't catch tops and bottoms, but just keeping an eye on that 50-day institutional moving average, which is that orange line, I think can be really helpful. Again, wish you guys all the best. Happy holidays, and I will see you guys tomorrow. Have a great day.